One of the hardest parts of trading is deciding whether to add when price moves against you. Most people instinctively do nothing, because doing nothing protects the ego. It lets you avoid admitting that the first entry was early. But early is not the same as wrong. In this trade, I added another 0.5 lot short at 4,150 even though gold had rebounded close to the initial short entry around 4,200. I was not adding because the position was already working. It was still fragile. I was adding because the market had given me another chance to build exposure at a better level, while the downtrend thesis had not been invalidated. That distinction matters. A rebound does not automatically mean reversal. Markets often produce sharp counter-trend moves that feel meaningful, but do not actually change the structure. If your thesis is built on trend and invalidation, the question is not whether price has bounced. The question is whether the level that breaks the thesis has actually been taken out. Too many traders exit because the trade feels uncomfortable. But discomfort is not evidence. It only tells you that price is closer to your risk boundary. What matters is whether that boundary itself has changed. After scaling into the second short, the total size was doubled, but the stop logic did not change. The second short kept the previous stop loss level, because that stop was also the invalidation level for the downtrend. That is the key point. Scaling in only makes sense when the added position still belongs to the same thesis, with the same failure point. The numbers matter here. The potential unrealized loss on the added short was about $600. The realized loss from the first leg was $700. Combined, the total was $1,300, or roughly 0.6% of the account. That is a manageable amount of risk. It does not make the trade right, but it keeps the trade inside a framework the account can absorb. A lot of traders think in terms of average entry price. That is the wrong frame. The better question is, if I am wrong now, what does the full position lose? And if I am right, does adding here improve the structure without creating an oversized bet? Scaling in is not a confidence performance. It is a risk decision. It is defensible only when a few conditions are still true. The original thesis remains intact. The new entry does not require a wider stop. The total account risk stays small enough to preserve judgment. The added size improves the average price without turning into a disguised hope trade. And most importantly, the trader can accept the full loss without needing to interfere emotionally. If those conditions are missing, averaging into a losing trade stops being disciplined and starts becoming stubborn. The difference between the two is thin. The line gets crossed when you add because you want to avoid regret, not because the market still offers favorable asymmetry. I am still waiting for the downward bias to be realized. That is the right mindset. The market does not owe you immediate confirmation. Your job is to define risk, enter where the asymmetry is acceptable, and stay flexible if the thesis fails. That is the real lesson here. A trader can be early and still be correct, if size is controlled and invalidation is respected. A trader can also be right on direction and still lose badly if position sizing is careless. Survival comes first. Compounding comes after that. If the second short is stopped out, the loss is acceptable because it was planned within the broader risk budget. If the downtrend resumes, the added size improves the position from a better level. Either way, the trade is judged by process, not by comfort. That is the standard worth keeping, not whether a trade feels safe, but whether the account can absorb being wrong while still giving the thesis room to work.